Harry, thank you very much indeed. Let me just put this through. Let me first of all say how pleased and delighted I am to be here again, and thank you, Moira, for inviting me along. The heading for my presentation today is Beyond Brexit, and a consequence of the title of Beyond Brexit is that probably the two things that supposedly beyond forefront of your minds maybe at the moment. One begins with B, which is Brexit, and the other probably begins with C, which is Corbyn. And I don't intend talking about either of those, except that actually what I've got to say will help, I think, set a sort of framework for thinking about those issues. And as I think Moira may have indicated at the beginning, obviously we're very open to take whatever questions there are on these subjects anyway. But let's talk about what I want to talk about specifically. And I rather bravely address this next slide, and if you like, the sort of subtitle for this presentation: "This time is different." 4 words which have been described as the most expensive words ever in the history of investing, managing private wealth, or whatever. But this is important, and the reason why this time is different is extremely dangerous, because often it has been used in the past, or has been used, as a way of sort of thinking, well, it's, you know, that what's gone in the recent past is going to stay forever, and actually it's just telling you that you're at the top of a bubble or something, and if you sort of think this is the new normal, you'll probably lose a lot of money. And there will be people who think that what I'm about to say, and there'll be people in the room, no doubt, is very much of that ilk. So I'm aware that this is quite dangerous. And by the way, I'm not giving any sort of investment advice whatsoever, let me say. But it's really picking up some of the points that Martin referred to in his presentation, and taking as a starting point the story of sort of why interest rates are so low at the moment and how we ought to respond to that. Some of those responses are sort of forced upon us. And whether it matters that interest rates are so low, and what's the relationship between interest rates and the sort of gloom and doom about prospects for global economies. But rest assured, this isn't supposed to be a sort of what the Americans might refer to as sort of economics 101 on the relationship between the interest rate and rate of growth of the economy. But this is all sort of really important stuff. And it's one of the sort of stylized facts, but actually it's rather more than a stylized facts about private wealth management in the UK, in North America, in Asia, in Europe, basically around the world, is that on average, private clients, private investors of a wide range of wealth band, you know, sort of doesn't matter if you've got sort of 1 million, 5 million, 100 million, a billion, in terms of your sort of net worth, virtually all types of investors, on average, seem to have somewhere around 20 or even 25% of their wealth in cash. This is massive. Fund managers initially sort of think, no, there must be some mistake. That can't be right, because, of course, they never see that. Because typically wealthy individuals will keep a fair amount of their cash in different sorts of places and rarely sort of put it all with one particular advisor or wealth manager. But the point I want to make about this chart here, really emphasizing it, is that sort of I say that savers have never, ever been paid so little for their cash. This matters enormously. We often hear, and in some ways this is correct, that, for instance, as a result of, say, the response to quantitative easing and sort of response to the financial crisis, that actually the response of central banks was to drive up investment values and to drive up house prices, which is all very well if you're already wealthy, but actually if you're not wealthy, you in effect transfer wealth from the from the poor to the rich. Now, there are all sorts of distributional stories, but one that often gets overlooked is just how much income has been evaporated and taken away, in effect, from people who have built up savings over their lifetime through the collapse and effectively the disappearance of regular, decent income from cautious investment strategies. And I'll come back to that, this emphasis on cautious investment strategies in a moment. But just suffice to say that over 200 years ago, in fact, if you go to the Bank of England Museum in the City of London, there's an example of a so-called Navy 5 annuity certificate made out to Jane Austen, written out to her name, where the Navy 5% was the yield that if she had bought it at sort of a pound per pound nominal, so to speak, actually she effectively apparently got about 6%. So she got locked in an income of 6% 200 years ago. Now, the rate of inflation actually was moving around quite a bit from sort of year to year, but actually it was clear this was a very good return. And as compared with anything on offer now, that's sort of, it's a completely different era. The experience of almost negligible income from bank deposits and sort of just cash held at secure institutions at the moment has never been so low. And this is why I say this time really is different. And the question is, will this continue? Why is it like this? Does anybody know why it's like this? And we'll come back and make some comments about that in a moment. And how should we respond? In fact, as Martin mentioned, it's not just in the UK. In the UK, in a sense, okay, so if you lend the government for 10 years at the moment, you will get cumulatively over 10 years about 7% income back from that, 7%, so that's 0.7% per year. In Germany, it's a negative amount, and what this means, and sort of the immutable words of President Donald Trump, he sort of twigged onto this apparently and asked his officials why the US federal government was still paying interest on federal debt when the Germans apparently didn't need to pay, and on the contrary, people paid them for the privilege of looking after their savings. Well, the answer, and this is quite important, and I'm sure this was probably the one that was, or variation on this, given to President Trump, is that actually it's a sign of weakness in Germany, not strength, that they have these so-called negative interest rates, whereas in the US, it's a positive interest rate, but still a relatively low interest rate. And the question of why yields are so low is something that economists are sort of grappling with, and there are all sorts of different competing hypotheses. Part of it is because inflation is low. There's quite a lot of talk about demography and changes in population and savings, not just in the UK, but across not just the developed world. I mean, just look at the stories coming out of China of how their population is aging. Aging populations mean a number of different things, one of which is everywhere people save more for their retirement. When they get to retirement, most people still worry enormously they haven't saved enough and that end-of-life care may be terribly, terribly expensive. But in addition, aging populations typically are less productive populations because you know what? Much smaller proportion of the labor force and the available labor force is young, and more of it is old, and as the population typically, as a sort of crude generalization, this does matter for productivity. And productivity is really important for businesses, profitability of businesses, which all feeds back, actually, into interest rates. But nevertheless, this is the sort of thing on which stories and accounts will vary. But it matters because the question is, should we reasonably expect this to bounce back to whatever we might consider to be a more normal rate, or should we accept that this so-called new normal is roughly where things are going to stay. The minimal amounts paid on bank deposits actually ends up making disappointing returns much more likely. Now, in the last sort of 10 years or so, or more, actually more than that, the experience of negative returns from well-constructed, balanced portfolios of the sort that FPC put together, generally, by and large, obviously nobody is immune from what goes on in markets as a whole, has not been that great. When you start with negligible interest rates, having traveled down from a period of higher interest rates, that journey towards the very low interest rates inevitably provides a cushion. It made it less, it gave you returns that were actually become increasingly difficult and increasingly unlikely that they will be repeated in the future, except by taking more risk. And in general, the idea is one doesn't want to take more risk unless one's circumstances have changed such that it would be a desirable thing to do. The Bank of England has recently some of its directors have made a number of speeches worrying about the fact that low interest rates are actually encouraging people to take more and more risk, and this worries them. So if, particularly in this sort of environment, if something appears to promise a very attractive return, I mean, one always says sort of, take a deep breath and read the small print, or question people about the small print. This is an environment in which it is particularly important to remember that anyone promising anything more than essentially what the government bond is promising, which is sort of a bit less than 1% a year, needs to be questioned about what sort of risk is involved, because the only way you can beat that is by taking risk. Let me move on. The global economic background is a sort of source of concern, and there have been numerous comments about whether we're about to have another recession. And for the last 5 or 6 years, there have been sort of people worrying, well, surely it's about time we had a recession. I'm certainly not going to suggest that somehow, the recession has somehow, the central banks have learnt the lesson. We thought that before 2007, 2008, or I'm not sure we thought it. It was sort of hints that somehow the ability to manage economies had been solved as an issue. At the moment, though, what is clear is that numerous indications that the world or the industrial economies are slowing down and have been slowing down in a fairly long-term sort of way, have been confused with the idea that another recession is around the corner. I'm not suggesting that another recession isn't around the corner, but it's important, I think, to distinguish the two. Let me just sort of show quickly a few charts that are going to highlight the difference between the developing economies, particularly, if you like, the powerhouses of China and India, powerhouses in the size of their growing weight in the global economy, with the industrial economies. The United Kingdom in this chart is shown as blue, and the other industrial economies are shown as yellow. What you can see there is roughly the UK and the other industrial economies are growing round about 2% a year and expected to grow there or thereabouts in the years ahead. This is quite a lot less than was the norm before the recession or immediately after the recession, and it's actually significantly less. And if you think about how that look at how this relates to the global economy, this is quite instructive, because the black line there is the global economy. On the left-hand side of that chart, the global economy seems to be really performing on average roughly as the industrial economies are performing. And yet at the second half of that chart, what you see is that the global economy is magically taking off from the rest of the economy. And the difference is, of course, it's the emerging markets, it's China and India in particular. The left-hand side of the chart, if you look at how the accepted measures, there are criticisms of all the different measures, but the most commonly used measures of world GMP. On the left-hand side of that chart, so that's back in the early 80s, emerging markets, developing countries, represented about 1/3 of the world. They now represent 2/3 of the world. And this is really important because don't forget, interest rates, for instance, are set on the right-hand side of the chart, but it also means it's just such an enormously changed and rapidly changing world. The red line there shows how the emerging markets have been growing year by year. If we just move on to this one, though, I'm going to come back to that previous one. This shows shares of world output. This is the emerging markets or the developing economies, starting off on the left-hand side at around 1/3 and ending up on the right-hand side at roughly 2/3. It's an extraordinary transformation. Anyone who's either been on business or traveled on holidays to China or India or places like this would just be aware, as compared with the India and China they may have heard of in their youth or childhoods. This is completely different when you go out there now.
Peter, 5 minutes.
Sorry? 5 minutes, very good. This, though, is the share of world output, and that there is the share of the United Kingdom. Now, talking about the world going forward, and this does matter for sort of looking out at the world ahead and investment opportunities for the future, there are several things that I want to sort of pull together out of this. This is, again, another chart where the blue line in the middle is the United Kingdom, and above that is the emerging markets, and below that, the developing countries. The United Kingdom is a small fish in a very big pond, but that pond is increasingly dominated in a very substantial way by the emerging markets. In terms of equity markets, where they will sort of crop up in investment portfolios of your wealth, they're under 1% in 88, and it's around 12% or so now, which again is much less than their weight in the global economy as a whole. But as everyone would know, actually a lot of the profits that's generated in the emerging markets is actually earned by multinational companies, which one is already exposed to through the various companies that are listed in North America or in Europe and the UK. In terms of the UK, in sort of, again, looking forward further out, productivity is an important key to national prosperity, and different ways of exploiting future opportunities. It's both a matter of sort of what opportunities are out there and how can the UK and different markets and companies in the UK and different countries respond to that. A lot of that has to do, we're having a bit of a discussion about sort of reasons to be optimistic, or reasons to be whether any reasons to be optimistic at the moment about the UK. And I was trying to suggest, somewhat timidly, that actually there is plenty of scope, probably, to raise productivity growth. But what we have to do, and what needs to happen, is various obstacles. It requires policy responses that enable various obstacles to productivity to be easier. It has to be easier for people to move around to get jobs. When people can, a bit like with the advantages of international trade, one of the advantages of international trade is that people do what they're most productive at doing. Likewise, we need to make it easier for people to do jobs where they can do it most productively. But what I would say is that for the time being, at least, one ought to assume that savings will be likely to be poorly rewarded. The developed world may well continue to grow relatively modestly, but the world is changing incredibly quickly. For investors, what this means is that we need a global approach, as indeed you have with FP&C, to investments. And for those, as a little footnote, I will mention the C word, anyone who's which is probably everyone, worried about what a Corbyn government might do to private wealth, one of the obvious things one can do is the firms that might be threatened by any of his policy proposals, the obvious way to diversify, because we don't know what the outcome will be, is to make sure you're globally diversified. But at the same time, we do need to adjust for the fact that we should expect much more modest investment performance and a seemingly accumulation of wealth from one's financial investments, than one's enjoyed and experienced in the past. The important thing is that wealth management is about the management of wealth. It's not really about the accumulation of wealth. And that.
Thank you.
Thank you.
Thank you, Peter.